Welcome to another video, Accounting with Tim. In this video, you're going to learn about IAS 8, accounting policies, estimates, and prior period errors. So we'll be going through a cartoonic explanation, which is going to cover up the theory behind these standards. Then following it, you will have a certain set of worked examples that will help you understand how the standard is practically applied in the concept of accounting. So, welcome you again. Enjoy the video.
You look worried. Anything bothering you? Yeah, I have the exams tomorrow and I have no idea what accounting policies and estimates are. Oh, don't worry, I'll help you out with it. Really? That would be amazing. It would be a life-saving thing actually. Let me grab my iPad and do some notes for you. Looking at accounting policies, policy would basically talk about the recognition, presentation, and measurement of financial transactions. When you say recognition, for an example, if you look at borrowing cost, that is basically interest on your long-term investments. Now, the borrowing cost could be recognized as an asset, or it could be recognized as an expense. So the method in which we are going to recognize the borrowing cost, whether we're going to take it as an asset or an expense, that's an accounting policy. The next one we'll talk about presentation. Now, when you talk about presentation, you would have depreciation as an example. Now, depreciation, you would have depreciation regarding your factory. So factory related depreciation, you could be taking it to manufacturing accounts. That is basically coming under cost of goods sold. Or else you can talk about your head office. So the head office would be taken into administration expenses. Or you can take about your motor vehicle. Motor vehicle will be taken into selling and distribution expenses. Right? So that is basically where you are going to present your depreciation charge. Right? So the area or the place in which you are going to present it in your financial statements, that's an accounting policy. The next one is the measurement. So now talking about depreciation itself, we have different measurement bases. The first measurement basis, it could be where you look at the pro rata basis. So that is basically where you charge depreciation in proportionate to the months of ownership. Then the next one could be you are looking at full year depreciation on acquisition and none in the year of disposal. So these are different bases in which you can charge depreciation. So these are measurement bases, right? So the measurement basis, right, whether we are using the pro rata basis or the full year depreciation acquisition, or are we going to measure our non-current assets on cost or the market value, the cost model or the revaluation model, right? Those are policies. Now, bringing into estimates, estimates is basically the monetary valuation. The monetary valuation of your measurement basis. Now, you can charge depreciation based on the pro rata basis or the full year depreciation on acquisition and none in the year of disposal, whatever the policy you select on. But you need to be able to value your depreciation. To value your depreciation, we can either use the reduce imbalance method or we can use the straight line method. So these methods are different estimation methods. These are estimation techniques, right? So policy would basically talk about the recognition, presentation, and measurement of financial information. Whereas when you talk about an estimate, it's about the monetary valuation of your measurement basis. Okay. So this is the difference between a policy and an estimate.
Thanks, bro. Properly understood what a policy and an estimate is. Could you please run me through how do you account for a change in an accounting policy? No worries. A change in an accounting policy is when there is a change in the presentation, measurement, or the recognition of a financial transaction. For example, if we are going to change our inventory valuation method from FIFO to AUCO, we are changing the measurement basis of our inventory. When there is a change in the accounting policies, we use a retrospective approach, which means we need to go into the previous financial statement figures, adjust the comparables, as well as we need to adjust our current year retained earnings to reflect the changes in the prior periods. Thanks, bro. Could you please do an illustration for me, please? I'm kind of a little confused on how to do it practically.
So on screen, you are looking at the statement of profit and loss for 2000X0, gross profit calculation, 2000X1 SOPL, as well as the statement of change in equity for 2000X1. So 2000X0, I have made a profit of 35,000. That's what I'm showing in my statement of change in equity. Below you see the entity decided to change the measurement basis of the inventory from FIFO to AUCO due to the volatility in the unit price of the product. As per the AUCO, the closing stock values would be as follows. 2000X0, the value of the closing stock is going to be 13,000. So before the adjustment, when we were using FIFO, the closing stock adjustment is 15, right? Now you see the closing stock is decreased by 2,000 to 13,000. 2000X1, the value of the closing stock is 14,000. Now what has happened is the measurement basis has changed from FIFO to AUCO. So this is a change in an accounting policy. If it's a change in an accounting policy, you need to use a retrospective approach. That means you need to adjust prior period retained earnings as well. So what we will be doing is we'll adjust our figures in our 2000X0 statement of profit and loss. So the only adjustment is going to be with the closing stock, which is 13,000. So when your closing stock decreases, your cost of sales increases. So you see your closing stock decreased by 2,000, your cost of sales increased by 2,000. Because of this, your gross profit has decreased by 2,000. So in my statement of change in equity, I will be reducing 2,000, right? Because of the change of it. So after the adjusting for the change, my profit should be 33,000. So if you do the adjustment on your statement of change in equity, 35 minus 2, you get 33. Then when you look at your statement of profit and loss for 2000X1, your opening stock is going to be 13,000, the new value of your inventory, right? So profit for 20X1, I will be recognizing 31,000. So the total of your statement of change in equity retained earnings is going to be 64,000. If you look at it, 33,000 in 2000X0 plus 31,000 in 2000X1, that would add up to 64,000. Now, the reason that we do these comparatives is, see the gross profit margin. If it wasn't adjusted, the 2000X0 showed a 50% profit margin. If it is adjusted, I show a 47% profit margin. And in 2000 X1, I have a 38.75. So now when I compare my gross profit, I should be looking at the adjusted figure in 2000 X0 and the 2000 X1 figure. Because in 2000 X0, I have used a different policy to value my inventory. So this information is not consistent with the information presented in 2000 X1. So by preparing the comparatives, I make sure my 2000 X0 figures are consistent with the 2000 X1 figures.
Thank you, bro. Finally got it. How do we treat for an accounting estimate? Well, an accounting estimate is easy. You just keep doing the calculations based on the new estimated figures we have. Let me show you an illustration of that as well.
An asset was purchased 2 years ago for 350,000. The directors chose to depreciate the asset using the reduced imbalance method and so use the rate of 20% per annum. The directors have decided that a fair representation would be given if the depreciation method was changed to the straight line basis and will implement the new depreciation method in the year ended 30th June 2000 X1. At this time, the directors estimated that the remaining useful life was 8 years and the residual value was 11,500. An asset was purchased 2 years ago for 350,000. The directors chose to depreciate the asset using the reduced imbalance method and so used a rate of 20% per annum. The directors have decided that a fair representation would be given if the depreciation method was changed to the straight line basis and will implement the new depreciation method in the year ended 30th June 2000 X1. At this time, the directors estimated that the remaining useful life was 8 years and the residual value was 15,500. Calculate the depreciation charge for the year ended 30th June 2000 X1 in respect of this asset. Now, this is a change in an accounting estimate, right? The basis of depreciation is not changing. This is basically the estimation technique used to calculate depreciation is changing. So this is a change in an accounting estimate. So we will not be changing our past financial statements. You'll be using a prospective approach where the change is going to be in effect for our current financial year. So I need to calculate the net book value of this asset after 2 years. So the net book value, we can use a shortcut where we use the compounding equation. So 350,000 into 1 minus R, the rate is going to be 20%. So this is after 2 years. So the net book value of this asset is going to be 224,000. Now, if we are going to use into the change in an accounting estimate, we only look into the change from the current year. So what I'll be doing is I'll be taking the carrying value of the asset. Now, instead of calculating the depreciation on the reduced imbalance method, I will use the straight line method. So carrying value minus the residual value divided by the remaining useful economic life. So the carrying value is 224,000. The residual value is 15,500. The remaining useful economic life is going to be 8 years. So 224,000 minus 15,500. So it's 208,500, your depreciable value. That divided by 8, your depreciation per annum is going to be 26,063. So For the year ended 30th June 2000X1, I'll be charging a depreciation of 26,063.
When you look into prior period errors, so you need to go and correct those errors, and you need to state your financial statements after adjusting for those errors. Now, I assume that you enjoyed this video. If you did enjoy the video, do give a like to this video. Do comment your thoughts about this video. Do let me know what topic you would like me to do next. And also do subscribe to the channel. Help me grow this channel and reach more students and help more students in their qualifications. Thank you very much and good luck.